Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today, we're going to be taking a look at the markets and then planning and placing an example long call vertical spread. I want to make sure that I go at a pace that everybody can follow, so we'll talk about the market conditions that might be appropriate for that sort of an approach. We'll talk about the pros and the cons. We'll actually place an example trade, a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody that's chatting in. Good to see so many familiar names, all as always, out there in YouTube. Hello there, Greg and George, Ricebird, David, John, JB52, Gary, Vic, Lou, Ted, Will, everybody else. Thanks for joining us week after week. We really always appreciate your attendance and your contributions to these discussions. I saw a couple of names out there in YouTube that weren't entirely familiar to me, so if you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after we've concluded the presentation, well, enjoy the show, but be aware that you're invited to join us in a live discussion. This is a Thursday webcast series, and we kick things off promptly at 11 Eastern. We'd love to have you here in the live audience. And to help out with our live audience, my very good friend Connie Hill is going to be hanging out in the chats. She's going to be addressing any questions that I can't get to just during the flow of the presentation. Connie is fabulous coach, brings a lot of knowledge to this discussion. So thanks for having my back there, Connie. And Connie and I would like to issue an invitation to everybody watching. If you have an account with X, you should be following your favorite presenters on that platform. It's another great resource for connecting with your favorite presenters. So you can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. But let's get into this discussion of trading long call vertical spreads. And as we do, of course, they include risk. So yeah, these disclosures are important. Please bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so here's what we're going to cover today. Three things. Number one, we need to look at our existing positions, see what's going on with those, see if we need to manage any of them. Number two, we need to take a look at the markets. A lot of things going on there. It's going to set the stage for our discussion. Then we're going to move to planning and placing a long call vertical spread. So we're going to be talking about the pros and the cons of setting that thing up. Going to use an example trade and place that trade. So let's go right to our existing positions. And right now, here's our long verticals and diagonals trade group this is on the Thinkorswim desktop trading software platform. We have 4 current positions and 1 position that just ended since the last time we talked. We had that third Friday expiration last week. So let me just go show you that one first. So we had a position in Lowe's where we bought some 240 long puts. We sold some 230 short puts. With this, we prefer for the stock to be below those strikes as we hit expiration. So here's our expiration right here. I actually drew a line to show where we were at expiration. There we are. We actually were down in that maximum theoretical gain territory. These contracts assigned in the money in real life, pardon me, a little hitch in the throat, but in real life, what would almost certainly happen here is, well, somebody has the right to sell shares to us for 230. That's assigned. We also have the right to sell those same shares to somebody else for 240. So we buy at 230, sell at 240, $10 profit minus the cost, which turned out to be $7.20 per share on this trade. That left us with our theoretical maximum gain, setting commissions aside from this discussion, but basically realized maximum gain of $2.80 per share on 5 contracts. That's 500 shares. So that was a $1,400 profit on that trade. So that one's done. On to our other positions, though. Let's start with Amazon. So with Amazon, we have what do you know? A long call vertical spread. Bought the 185s, sold the 190s for the 16th of May. The preference here would be for the stock to be above 190 on the 16th of May to be in position for the best case outcome. We have some work to do. We're at 184. If we look at that on a chart, we entered the trade here. The stock fell down below our strikes, but we're in recovery mode. Just a week ago, this was looking like a low probability scenario. It's getting there. Another day or two of buying, and we could be right back up in our max gain territory. We want to be up here above 190. So we have time on these contracts. We're going to let that one continue to work. With Broadcom, this is a long put vertical. This is a bearish strategy where we bought the 190 puts, sold the 185 puts. We'd prefer to be below 185. Look where we are right now. 184.82. We're teasing, but we're where we need to be. We just need time to go by. And obviously, we'd like a little more breathing room. We'd like the stock to fall further. So this is what this looks like on that chart. Since we initiated the trade, it's actually come up. And you can see how close we are, but we're possibly bumping into this resistance. We'll see if that price ceiling can hold. We'd really like to see things come back down on Broadcom from here. Jonathan says you can't trade options, so this is not the right webcast for you. Yeah, Jonathan, this one's all about options trading, but we have a whole slate of other webcasts. So yeah, if you haven't subscribed to our Trader Talks channel, it's not all about trading options. We talk about trading stocks and managing larger portfolios, that sort of thing. So if you haven't subscribed to our Trader Talks channel, do that first. You can pop down below the video stream right now and click on the subscribe button. That doesn't cost anything, literally takes a second. But then you can come to our channel here on YouTube and go to the playlist and find a topic that's most interesting to you. It may not be this series, but we have a range of series right down all the way through here. So I'll let you look through that, but let's get back to our existing trades. Yep, this one making us a little bit nervous, still in good position. We just need it to back off a little bit. All right, so GILD, this one is an interesting position. So right now, let me show you what we have right now. At the moment, we own a $95 call, 17th of June of 2027. This is a position that we initiated on January 9th, and we decided we're sticking with this one. No matter whether we're smooth sailing or rough seas, we're sticking with it. We're going to keep that long call and then sell short calls against that. Well, it's been a little bit patchy, but no, I'm sorry. Nope, sorry. No, that was the UNH position. But in this case, we are in a longer term call position. What I'm saying when I say that's the UNH position, UNH is the one that we're going to stick with. But here's what's going on with Gilead. Bought this $95 call. It's doing pretty well. We've sold a few short calls against that along the way. Some have gone well, some not so well. So we took a couple of losses here, took a couple of gains here, but right now we've sold that 110 short call. So own a long call that doesn't expire for a long time. We have a short call that expires right here on May 16th. So the preference is for price to rise. That'd be helping out our long call position, but we'd like it to be below 110 as we get to that May 16th expiration. So really, it's doing just about what we might have hoped it would do. Get up here closer to 110, that'd be optimal. Just below that level at expiration for that short strike would be perfect. Now, finally, we do have that UNH position. So UNH is underwater, but overall not as much as it initially appears. So as it's currently constructed, we just own a 520 long call. But along the way with this one, we've sold a series of short calls and made profits on each one of those. So let's look at this one. This is the one that we initiated on January 9th. That was right here. And the preference would be for the stock to go up to help out that long call, which it was doing until a few days ago, where this earnings announcement came right in with different ideas, caused the price to collapse. But along the way, we sold a 560 short call, closed that one out, sold a 550 short call and closed that one out. The 540 short call, closed that one out. 530, this one just expired out of the money on this big gap down. So those profits add up to, I think, about $2,400. That helps with the loss that we've taken on the long. Doesn't completely mitigate it though. We really need this to go up. But this has put us in a unique position. And I wanted to talk about this because this is what can happen when a trader commits to something, no matter what, transpires. We can find ourselves in a pretty sticky situation. So right now, all that we have left is this 520 long call. That's it. So obviously we have a bias for the stock to go up. But along the way, we've also found that we can sell short calls against that. Sometimes that can contribute its own profit potential. But we've fallen so far, we're way down below our strike. If we sell a call, let's say we sell a 440 or a 460 or a 480, what we would be doing is entering into a contract where we're agreeing to sell the shares for less than we can buy those shares for according to the terms of the 520 long call. We almost did that last week. If you want to go back and revisit the archive from last week, I almost did that and I said, no, let's hit the pause button on that. But I wonder if we gave this enough time. Here's the thing. If we tried to sell, because here's what some traders might do. They might say, well, okay, well, let me just sell a call that's above the strike that I own. That's just a normal diagonal spread. But the problem is, this thing is so far out of the money that there might not be much credit if we were to sell like a 530 call for May. So here's what we might have to do. Let's change our right expansion settings. This is just adding extra space to the chart here. Click apply and click OK. I might look out here to July. We're going to sell a call all the way out. I haven't done this in a webcast before, going this far out, but we're going to sell a call up here, maybe above the 520. Let's see what we get for a 530 call all the way out there in July. The advantage of going this far out is it gives it enough time that there may be enough premium to make this quote unquote worthwhile. The disadvantage is that we now have a cap on how far we'd like the price to go for a longer period, so about 3 months. So let's go have a look. Oh, and by the way, there's a survey. Great. Okay, let me navigate over here to the trade tab. Let's go out here to the 18th of July and scroll down, and we'll just pause there. There we go. But yeah, there is a survey, so thank you. Raymond says, should you think of this as a sunk cost? Raymond, a trader might make exactly that decision. Right now, we are in a very bullish position. We own a long call that has a lot of time left on it. We definitely prefer for the stock to go up. If the trader doesn't think the stock is likely to go up from here, probably ought to just sell the call. But this is one that we took on January 9th, and we said, let's just trade it all year long, see what happens. So we're not going to leave this. We're not going to sell the long call. That decision was made a long time ago, but that's not saying it's always the right decision, right? Anyway, but yeah, let me just say, for those of you who are here in the live audience, if you'd click the survey link that's been added to the chat window, if you've never filled out one of our surveys before, a quick note here, they're just very short. 2 multiple choice questions, a comments box and a suggestion box. But I just promise you, if you take the time to fill that thing out, I'll take the time to read through it. I read the data, I read the comments, and it helps, okay? But yeah, here's what we're going to do. Going out here to 18th of July, if we look at that 530 call, it's trading between $3 and $3.40. Maybe we can get $3.20 out of this. I might have to settle for $3.10. Let me click on that bid price. So remember, we just have the one contract here. So I'm going to click on that 530 call bid. Let's sell one of those 18th of July 530 calls. I'm going to actually leave it at $3. Let's click confirm and send, see if we can get a fill on this. Selling that one 18th of July 530 call, that could bring in $300. If that contract expires worthless, that can continue to help us sort of dig ourselves out of a hole here. This will say that there's a maximum loss that's infinite. That would be the case if this were a naked call. It's not, because we also own the long call. But our credit after commissions should be a minimum of $299.35 if the order fills. And let's send that order off, see if that fills. And while that's working, there it is, filled. Let's draw in a line here at 530. So here's today's date. Let's go up above today's date. I'm going to go up to 530. This just sort of visually represents that call that we sold. It gives us a big...
Now, I know Cameron was setting up to do a long call vertical here. However, I'm going to like switch gears on us. We'll still do a long call vertical, but what we're going to do is I want to show you a watch list that we're using in the short verticals class. In fact, we're going to update this watch list today in the class a little bit later on at 2 Eastern time. Is this the list that I have right here, SV 32025, that's when we created it for the short verticals. And it's a watch list that we're using so that we say, you know, if we find a setup on it, we are comfortable trading any of those stocks. Okay. So we've kind of already pre-screened them. Most of them have sufficient activity in the options, and we're trading in both bullish and bearish directions. So if I were just coming here fresh, looking at this list, usually I'll just sort things by the percent change for today. So we know which ones are moving what direction. All right. So obviously the better movement is on the top, and those that might be even negative are down here at the bottom, like IBM, Pepsi, and so forth. Now, most of these came from the S&P 100 and the NASDAQ 100 is the source of these stocks, with a little filtering done on each end, like I'll show you this afternoon. In any case, let's see if we can find something that has a fresh entry. Fresh entry would be, since the market's a little bit more on the bullish side today, we'll go off the bullish ones, right? So a support bounce that could hold, a moving average bounce, or a breakout over resistance, or some sort of price pattern, like a triangle, a flag, that type of a thing. Now, some of these, when they've moved quite a bit, you're kind of like, I don't want to feel like I'm chasing it. But let's just maybe start looking in this area and have some conversation. Now, Lam Research had their earnings. Apparently, the market liked what they had to say. So we've got some continuation of that move here today. The question is going to be has its short-term trend changed? Okay, we have here, let's get the drawing tool working here. Obviously this low, and then we have pretty decent high here, right? And that giant rally day. And then it puts in a higher low. So we have our first higher low. And then today and beyond, we're looking for another higher high. So something to go beyond there. When we have a higher high, a higher low, the very short-term trend has started to change. But some people want to feel a little bit more comfortable that things maybe have moved a little bit more than just barely. So we're going to keep going down our list here. But that's essentially what we're looking for. And let's make sure we're on 6 months. There we go. All right. Oh, let's get rid of those yellow marks. ARM Holdings, kind of a similar situation. I think what we're seeing here are some breaks of diagonal resistance, which is another thing we can watch for. Higher high, higher low, and a break of diagonal resistance. Now, we don't have it drawn in here, so let's do it, because I think we're going to be starting to see some patterns with that. So let's go ahead, let's draw it in here. And some people are comfortable with diagonal breaks, recognizing that it could be very early in the move, and there could be other people maybe, again, wanting to have a little bit more confirmation, okay? Let's go ahead and see what, we've got that higher low, maybe barely a higher high today. Hasn't closed there, but we do have that break of resistance, which some people feel comfortable with. So let's come over here and let's structure a long call vertical trade, going on the bullish side, knowing maybe it might be a little bit aggressive. Some people might want to do a trade like this with a stronger trend in place already on something that's been going up for a longer period of time. All right, when we're structuring the trade, many times traders like to use a time frame between 20 to 40 days, okay, of time. And when stocks have these weeklies available, that really frees things up quite a bit. Weeklies typically don't have, I should say some of them don't have as much open interest. Here's my open interest column, which I like to keep on here all the time, because I want to see what kind of contracts we might be dealing with. And so it's nice to be able to see, and sometimes the activity for the day can help as well. Now, as we're looking at, say, the 109 here, actually, there's not a ton of open interest except at these $5 increments. Okay, so that's all right. We will do it at the $5 increments because there's oodles of open interest there. So let's take this 110 and then we'll spread it out by 5. So we'll go 110, 105 here. We'll say buy vertical. And this is going to be structured such that we need the stock to move. Typically on these long diagonals, long verticals, many times we're setting it up where the stock really needs to move quite a bit. So let's change this 111. Let's come out here to, we were going to do 110, 105. Nope. Oh, I was looking at the put side of things. 110, 115. That's where we want to go. Out of the money on the call side. Let's make sure our open interest is good here as well. And sure, yeah, it certainly is. Now some people will say, okay, does this look like a realistic move for the stock in 20 some odd days, right? And so we're looking for it to maybe, let's zoom in here a little bit. We would be looking for the stock to get up to 115. So I'm going to get my mouse at about 115. That's about as close as I can get. And so when you're doing a technical analysis, it's like, well, are we requiring the stock to do a really big move or a small move? Okay. I would say this is not a huge move. It's not like we're shooting for 120 or 125 or 130. Those I would consider longer moves. 115, I would say maybe is just a little bit of a shorter move. Okay. All right, let's come back over here. We would be willing to put out 223 to gain $5 difference in the strike prices minus the 223. Let's grab our calculator here. So we'll take our 5 minus currently 2.23. So the maximum gain on this particular one would be about 277. So looking to gain about 100% return, right? A little bit more than that. So again, we've got 22 days for the stock to make the move. Well, let's go ahead. Let's consider this. How much of this gain, potential gain, 277, would you be happy with? Would you be satisfied with? Okay. One thing that some option traders like to do is they like to say, all right, rather than trying to get every stinking penny out of the spread, what if we just get a big chunk of it, right? And be satisfied with the big chunk. All right. So for today's purposes, and many times I'll use about 70%. Now, you don't have to do exactly 70%, right? You can decide. Maybe you're happy at 50. Maybe you're happy at 60. All right. So let's go at 277 times, and I'm going to go here, 0.7. And so if we had 70% of it and 30% was left, what we're looking for is kind of an increase of about 193. And I'm going to add that to our 218. I know it started at 223. And that's going to be about 411, 412. We could round that. Now, if this doesn't trade in penny increments, we might just round it to the nickels here. So let's do this. Let's do a first triggers sequential and put in that exit order at the same time. You don't have to put the exit order on at the same time, but if you want to, it can be a little bit efficient. Sometimes people want to hurry and put on the trade and then come back, set up exit orders. And in our account, typically we'll allow ourselves in our paper money account that we use here to risk up to $1,500 per trade, as indicated about there. And that's about 1% of our $150,000 portfolio. So let's go ahead and create an opposite order here. And then let's go buy it back and say, we're happy campers at $4.11. Okay, we're not saying we've got to get everything out of it, but a nice chunk would be nice, right? And then we'll go ahead and put that good till canceled. I mentioned we could risk $1,500 in our account. In this case, let's just do 4 contracts. All right, we're going to do 4 contracts. We're going to hit confirm and send, just kind of review it. Pretty standard order, so nothing unusual. And even though this does not show commissions, you would pay commissions. I don't know why my demo account doesn't pay or show the commissions, but it doesn't, but definitely would have some commissions there. And let's see, Sandy is noting, well, we have earnings coming up. Okay, we do. We have earnings coming up on the 7th of May. And so some people might say, that might be another condition that I want to be at. I want to be out of the trade before earnings comes. Some people will intentionally trade over earnings, right? And we'll set up some trades for this. But if you don't want to, take note of that date so that you're out of there. All right. Let's take a look at some more on our list. And this time, let's maybe focus on some that have a longer uptrend, right? Because market's very news driven right now. Oh, there's a question here. Can we go back to how did I get the 411 buyback price? Yeah, let's go through that math one more time. So going here, we'll come back to the trade tab, and I'm just going to kind of load this up again. Okay, we're going to do a buy vertical, and then we'll go change the strike price here to 115. And we got filled about 225, I believe. Okay, so I'm just going to drop this to 225. The math I did initially actually was 20, I think based on 23 cents. So we'll put it back to 223. So we know we're going to have a cost to the trade, which will be this net debit, right? Of our buying of the 1 long call and selling the 115, the one a little bit further out of the money. Makes the trade a little bit more affordable. This is especially helpful when you have some expensive stocks and you're having to pay $1,000 for one contract, do it in a spread, and it lowers the net debit considerably. Now, the maximum gain, we will calculate that, is going to be the difference in the strike prices, so $5 minus whatever our net debit is. So let's just run through that. So we'll say 5 minus 2.23. And that gave us 277, which I'm just going to kind of write here in the scratch pad. So then the question was, how much of that would we be happy to get? Do we have to get 100% of the 277? Or could we be happy taking a chunk out of the trade, closing it up and moving on? So the answer is that's what we're going to do. And you can use whatever percentage you like. In this case, we said 70%. If we can get 70% of 277, we would be happy campers. Okay, so I multiplied this 277 by 0.70. That gave us a value. That might be a little bit different than that initial value that I did here. Let's see how much different that is. $1.93. And so we're saying, okay, this is the profit we'd be happy with. So we're going to add it to 233 because that's what we want the trade. That's what we want the spread to get to in terms of its value. Okay, we want it to grow. All right, so let's add. I'm gonna clear this out to make sure we get the right number there. 193 plus 2.23. And so I guess I'm a nickel off from what we have here initially. Now it's calculating 416. I think I had 411 initially. So I'm off a little bit, a nickel here. And so that's why we said we would be happy to go buy it back at that value. So hopefully that makes sense to you, just kind of reviewing that a little bit slower rather than a little bit faster. Some people, they might be happy at 50%, right? That's why I'm saying you want to experiment in your paper money account and just kind of see how it works out for you. Because maybe you say, well, I want 95%. How often does it really work out that you get the 95% as you paper trade that, right? You might end up saying, well, maybe not, okay? In this case, that's why we put the order in to say 70% we're happy. Now, we talked about another exit would be watching before earnings. So see what the day is. It's the 7th, but it's in the afternoon after the market closes. So you would want to be out before the market closes on May 7th. You don't have to wait till then, but that might be one of your other exit signals that you're looking for. All right, let's go back to our list here. Let's collapse this. And let's go down our list a little bit further. And I want to look at some that maybe have had some activity a little bit longer that maybe look a little bit more bullish. All right. Palantir. This one was interesting yesterday because this 97-ish area had been support, was acting as resistance. Yesterday kind of broke through that area, but not in a convincing manner for some people. Someone would have said, yep, that broke out. Look, it had really just a tiny bit above average volume, so it had some decent volume there. Looks like it's having some nice follow through today. It has earnings the 5th of May. We'll be celebrating Cinco de Mayo. And so some people might say, you know, if it's coming up in the next 10 days, I'm not comfortable. Okay, I'm just not comfortable doing it. Okay, so they might pass. So we will pass on that one for that reason. Now, a lot of the financials have come through. They've have their earnings. Let's see what we're looking at here. Has the trend changed? Okay, we definitely had a bottom now here at 146. Now we've got higher lows from down here. And today and yesterday looks like a higher high. So some might say, great, the beginning of the trend measures up. Short-term trend is now bullish. See how close this looks to be to resistance, though. Okay, so about 185 there looks to be some resistance. So some folks might say, geez, we've got 3 touches there. You might feel comfortable doing an order, but you might say only if we get a break above that resistance level. We get a break beyond that resistance level, we could do a trade. So let's do a conditional order. And the order is conditioned on the fact that the stock goes above there. And I'm going to put my mouse like at that 187.22 area. At that point, a trader might say, I feel like it's really broken through there. There might be other people that say, I don't even want to put a buy stop order or conditional order on it. I'll just maybe set an alert and let an alert come in and I'll take a look at it then and then determine. So let's structure this trade here real quick. We'll get rid of our arm and similar type thing. Let's see here. So I said 187.82. So we could use the May options if you want a little bit more time because we're not exactly sure when it might go above there. You could come out here a little bit further in time. Just for simplicity purposes, we'll just go ahead and use these May 16s. We do have 22 days left in them. So we'll come down here. Many times traders like to start with the at the money strike price. Now you don't have to start it at the money, but that is a common way to do it. And then this is kind of nice because through this area here, we've got $2.50 increments on the options. After that, it's a little bit, it's out at $5. So some might look at this as say, you know, that might be the most desirable one, except for the open interest. Okay, so we're just going to go just to the 185. Technically, it is a little bit out of the money. If somebody wanted to be more conservative, they might do the 180. Let's just see what 180, 185 looks like. And okay, this actually would be a more conservative setup here, okay? Because we would be risking $1.50 to earn what? Basically $1.50, or a buck rather. We've got $2.50 minus our $1.50 would give us a $1 profit that we'd be seeking in this case. And the probability on it might be a little bit higher than the one that we initially went through. This is our probability of expiring out of the money. And actually, we want it to be in the money. So we just kind of flip that. Okay. So 56% chance at this point that it would expire in the money on that strike. And then the 85, which would go down to right now, let's see. I needed to change this to 185. There we go. And okay, 270. Now my time is almost up here, but this is how we could structure this trade. Would say, okay, 5 minus 270 gives us 230 of potential profit. Okay, so looking to spend more than what we have to gain is how that one would work out. So it'd say, okay, we're willing to look at 230 as our gain, max gain, and then 270 as our max loss. All right. Now, in the interest of time, I'm not going to put the order in, but at least we were able to look at a couple of potential example trades. And one thing that's really helpful is if you trade them along in your paper money account, especially if you're not familiar with that strategy, it's a great way to learn that. Now, I know we have a survey out in the chat. In fact, it appeared just about the time that Cameron lost his feed. In any case, we appreciate your feedback. We pay attention to it. We read everything that you submit. I would read, Scott would read, and I know Cameron reads and would want to incorporate into his webcast. So if you respond to the multiple choice and you want to let Cameron know something, maybe something you're struggling with, go ahead and do that, okay? And we'll make sure that he gets that information. All right. Hope you've already become a subscriber. Hope you're following both Cameron and I on X. Cameron May CS, Connie Hill CS. We'll have a short break, and I do not know what's coming up next. We've got another class at the top of the hour, so join us for that. Appreciate your attendance here today. Thanks, everyone, for your patience. Bye-bye.